This is the RedChip Video Internet Platform, your source for small cap market information.
Thanks, Jim. I'm Tony Rotondo, President and CEO of First Surgical Partners, and we are a surgery center hospital company based out of Houston, Texas. Currently on the OTC BB, trading under the symbol FSPI. A little over 40.5 million outstanding shares, market cap around $100 million. And I founded the company in February of '03. We opened up our first ambulatory surgery center here in Houston. We are 6 miles from the world's largest medical center, so we have a lot of surgeons and physicians and patients to draw from. And the idea behind opening the very first one, First Street Surgical Center, was to create a best-of-class facility that was in a very calming, healing environment, upscale enclave of Houston, where patients would want to come and have their surgeries done in a less hectic environment than a typical medical center environment. Had tremendous success with the opening of First Street Surgical Center, and 2 years later we opened up our second facility, First Surgical Woodlands. Woodlands is a surgery center about 50 miles north of here. It's in a suburb of Houston. It's done very well, do mainly spine and orthopedic and pain cases up there. The third facility that we opened in September of '06 was our first general acute hospital, and First Street Hospital is in Bel Air, and it's actually conjoined to our surgery center, First Street. And it gives us the flexibility and benefit of having both an ambulatory surgery center and a hospital. So it kind of accommodates the needs of whether it's an inpatient surgery or an inpatient admission or an outpatient day surgery. In August of 2010, we decided that we wanted to go the public route, and the reasons for that was it would give us access to capital and a quicker runway to grow the company and increase our footprint. A little bit overview about the industry that we're in the business of surgery and healthcare. We have over 90 surgeons utilizing our facilities. 34% of those are affiliated surgeons, which would be partners, and 66% of those are non-affiliated surgeons. The mix of the revenue mix is 42% of non-affiliated surgeons generate revenues for us, and 58% are affiliated surgeons. And the definition of affiliated surgeons are shareholders in our company. This slide kind of gives an overview of the specialty percentages that we practice every day at our facilities. We have you'll see of the 3 specialties that we primarily play in, bariatrics, reconstructive and plastics, and orthopedics comprise 70% of our business. We also do neurosurgery, pain management, podiatry, ENT, and gynecological procedures as well at our facilities. We are typically narrow in specialty, and we like to stay focused on these 7 to 8 different specialties and do them very well. Since inception, actually now, we have more than 46,000 surgical cases have been performed at our facilities in the 9 years that we've been in business. The next slide talks about how we get paid in our business. Who pays us? That's kind of important. The majority of our payers are commercial carriers, the BCBSs, the Aetnas, the Cignas, the big insurance companies. 6% of our business is workers' comp, 17% is Medicare, and 22% would be others, such as cash, self-pay, indigent, hardships, etc. The payer mix expressed as a percentage of our service revenue, the previous slide showed you as a representation of case mix. This shows you as a representation of payers. So Medicare, workers' comp, and commercial carriers, 85 to 80% of our collections are through commercial carriers. I like this slide because it shows the stability of the company. You don't see a lot of wide variations in our changing payer mixes. You see they're all within 3 to 5% ratio variations through the different periods. So very stable book of business, very solid foundation as a company. Keep in mind we were privately held for about 8 years before we went public, so got a long track record. How are we going to grow the business? What is our strategy to make First Surgical the premier publicly traded physician-concentric surgery center hospital company? Attract top quality surgeons and other physicians to utilize our facilities. We want to look at selective markets that are attractive from a healthcare perspective. We always can be more efficient in our operations. We like to be on the cutting edge of innovation and technology. We have a lot of orthopedic surgeons and spine surgeons that are always bringing us the latest toys that they go to. For example, the Orthopedic Academy was just this past week in San Francisco, and we've already had 3 or 4 partners, shareholders come back and talk about the latest technology out there. They always want to be on the cutting edge because they want to differentiate themselves in the marketplace, and we as their partners want to be the facility that has the latest technologies. A lot of robotics are coming this way where it's more and more efficient and quicker turnovers and quicker recovery for some of the more invasive surgeries. We hope to introduce a physician stock purchase plan as well as a stock repurchase plan in the near future. And then startup and development of surgical centers and the acquisition of hospitals in select competitive markets. These are our 3 operating facilities in the public model: First Street Hospital, First Surgical Woodlands, and First Street Surgical Center. Kind of a macro look at the ASC market. Talk about the ASC market for a minute here. Very fragmented. 23% of the business is by 50 of the top ASC companies out there. 77% of the market is highly fragmented. For example, 6 to 7 surgeons had the entrepreneurial spirit to start their own surgery center. They're out there, they're independent, they're physician-owned, and they're looking for a company to align themselves with going forward the next 5 to 7 years as you see some changes in healthcare going forward. There's a huge opportunity for acquisition and consolidation in the market, we feel. This slide kind of shows the trend as it relates to surgical procedures. In 1985, your father or perhaps your grandfather had his knee arthroscopy. In 1985, that would have more than likely consisted of pre-admission to the hospital the night before, surgery the next day, probably at least 1 night stay in the hospital, maybe 2, and then he would go home. Today, 77% of those same surgeries are done in an outpatient setting. That same case would be pre-registered at a surgery center in the morning, 45-minute knee scope, discharged by 11 to 12 o'clock and be on his couch or in bed resting in his own house by 2 o'clock. Healthcare has come a long way in those 25 years or so, and we don't see that trend changing. You'll see more and more pressure to go to more of an outpatient setting, get patients in and out quicker, and a lot of that is because of the technological advances that we've seen in medicine as it relates to equipment and technology and just more efficient procedures and more efficient surgeons, quite frankly. So you see a huge trend in outpatient procedures going forward. Kind of go back to the company, we recognized that we had an opportunity for the hospital expansion. We had a capital expenditure to increase our hospital, and we went from 5 beds to 19. And when we did that, we added more beds and more ORs to handle our capacity. You know, why partner with First Surgical? You can enjoy the freedom and financial benefits of owning an ASC or hospital without dealing with the day-to-day management challenges. There are a lot of regulatory issues, compliance issues that you have to deal with on a day-to-day basis. Partner with a leading surgical management team. Our senior management team has been in this space for 15 to 20 years with many years of managing experience. We look at valuations for acquiring existing ASCs. Depending on the market, it goes anywhere from 4 to 6 to 8 trailing EBITDA. Creation of a favorable model to attract new physicians, affiliated and non-affiliated. We're always looking to grow the business, and the lifeblood of our business is surgeons and surgeon cases, as well as physicians that want to utilize our hospital. We always have to stay up on the latest trends with state-of-the-art facilities and equipment. One of the things that we do is when we are building a new facility, one of the first things we'll ask our physician partners is, who do you want to work with? Who do you have a good rapport with in the OR or in pre-op? We'll go hire these people so that we can be as efficient as possible for our physicians. The next slide kind of talks about the overview of since inception, case volumes. This is as of 2011. Every year you'll see that we've gone up whenever you see a new facility open, and we've every year had an increase in growth. For the most part, 2010 was when we had a hospital expansion, and construction issues forced us a little bit to go down. Q11 represents only the first 3 quarters, but I believe we finished 2011 with our best year ever in terms of growth. We finished with approximately 6,500 cases for the company in 2011. That was up substantially of the previous year. And we have done over 45,000 surgeries since inception. We expect to continue that growth in the next 12 to 18 months. Just kind of quick snapshot financial summary. Net revenues year-end 2009 were about $44 million. In 2010, about $46 million, and then our run rate through Q3 of September of 11 was 38, but I think we ended right around 50 million for the year. So you can see that we still have an upward trend in growth for the company. The revenues and net income for year-end 10 were 46 and 5.7 respectively. The net income for the year included a tax rate of approximately 44%, primarily to reflect a change from a cash to an accrual accounting method. Going forward, management believes that the effective tax rate will be 35%. We're also a rare company because we're a dividend-paying stock. Every quarter we have dividends to our shareholders. Obviously, with the dividends, can't be guaranteed, depending on the profitability of each quarter. We have done a dividend every quarter that we have been public. I think we are just finished our 5th one. A little bit about the company. You know, first, FSPI, we've always been a growth income story. We were a privately held concern for about 8 years. We think that the future, with the ability to raise capital and grow the business, we'd like to be in the 8 to 10 to 12 facility level in the next 3 to 5 years to be a leader in that space. We're really focused on looking at attractive markets, whether it's in the Sun Belt, in the Texas area, and fanning outward, where there are states that are less obstacles to start business or look at acquiring existing facilities, whether that's a certificate of need state or not. What that means is there are certain states in the United States that have a law that requires you to ask the respective state for okay to proceed to build a new facility. Texas does not have a certificate of need state, but several do. So we always have to be careful and make sure which states that we want to practice in. A little bit about the senior management team. Dr. Jacob Verone is co-founder of the company with myself. He's a chairman of our company. He's a very well-known reconstructive and plastic surgeon here in Houston. Myself, I've been in the industry for going on 15 years, primarily in the surgery center space. So I've done this for quite a long time. Dr. David Tomasek is also on our board. He is the founder of First Surgical Woodlands. He's a spine surgeon. A tremendous reputation for being a great spine surgeon. And then Don Knight has been with us since inception as our CFO. Again, we trade on OTC BB under FSPI, and our IR firm is RedChip. If there are any other questions or comments, email info there. We have a website that you can go to. Jim, I probably went way too fast for today, so I've got plenty of time for questions.
No worries at all, Tony. We do have plenty of questions, so I'll jump right into it. Is First Surgical looking to make affiliated surgeons a bigger part of their surgeon mix?
It's a good question, Jim. I think what we look at is we always, as I mentioned earlier, the lifeblood of our company is surgeons that are utilize the facilities and bring cases and patients to our company. Whether or not that they are affiliated is a question that we do not take lightly. It's somebody that has to fit into the culture of First Surgical. If this is a good fit for them and their patients, do they get good outcomes? It really is a dating process, if you will, because we've had a lot of surgeons come through our facilities, and for different reasons it might not be a good fit. Maybe the drive is too far for their patients. Maybe the physician likes being in the medical center, and it's just a different way of life in our facilities. It's all about efficiency. We're in, typically our facilities are located in a calming, less hectic environment, and that fit is not for everyone. We're very focused on patient turnover in between surgeries, taking care of patients. So it's a reciprocating dating, if you will. So we look to add affiliated partners every quarter, but the board has to really feel good about that it's a good fit. And we typically have physicians that get credentialed at our facilities try the facility out for several months to see if it's a good fit before we proceed and asking them to be an affiliated partner.
Thank you, Tony. Next question. Could you give some more color into your current plans to open new ASCs?
Well, I think for us, generally speaking, what we want to look at are facilities that, as we are in the early stages of being a public company, that fit us geographically, as well as a cross-section of the partnership mix. We have had partnerships. We've actually acquired partnerships in a private life where our snapshot is typically whenever we start a new partnership or acquire, we typically look at one that mirror the ones that we've had success with, and that's 7 to 10 physician partners starting out, guys that are really focused and loyal to that partnership, and they will do everything they can to make that the center of excellence. In the past, we've experimented, and we acquired one that comes to mind about 5 years ago that we inherited. It had over 30 different physician partners, and we found that a bit unwieldy to manage. With all due respect, with surgeons, it's like herding cats, and when you have 30 of them, it's very difficult to make sound business decisions. So we typically like to start new centers with 4 to 5 surgeon partners, and then incrementally add a few, where we, and a perfect fit for us is ultimately having 10 to 12 to 14 partners after a year or two of putting it together. I think you'll see going forward, our preference is to do de novos because you have more of control of the product versus acquisitions. But I think that you'll see us add 1 to 2 facilities a year for the next 3 to 5 years, where we'd like to double the size of the company and continue to grow it that way.
Thank you, Tony. Next question in regards to your current dividend policy. What provisions are being made to meet your balloon debit payments that are recently or in the near future due?
Well, we've got some payments that are due, I think it's January of 13, and Don Knight, our CFO, and myself are currently involved in doing a refinance of the company's debt, which will allow us to take care of that. It's something that we knew we've been well aware of for the last year or so, and we're pretty far down the road in terms of the refinance where that will be a non-issue here in the next year or so.
Thank you, Tony. Next question. What is your current ratio for in-network versus out-of-network patients in regards to the the insurance area?
It's a great question. Typically you'll see in our industry, typically the bigger hospital systems, they don't really play in the out-of-network space, and what that means by out-of-network, for those that aren't familiar with that, is that you don't have a contract with a payer. Certainly well within your right to not have contracted a contract with one of the big payers. If you don't feel like the contract is worth the value of doing business, you can opt to get paid at out-of-network rates. It's a little less sure of the reimbursements, but typically out-of-network rates will pay you more than in-network rates. The big hospital systems, such as in Houston here, the Methodist and the Memorial systems, to name 2 big systems, they're usually completely in-network. First Surgical is a small enough company and a nimble enough company that we can navigate being a hybrid. We will have a couple in-network managed care contracts, and we'll stay out of network with those that we just don't feel like we can come to an agreement on a contract. It's a game that takes skill and expertise and experience, quite frankly, to understand how to play the game of negotiations with your payers. It's something that we focus on every day. The mix for us is probably 50-50 in terms of in-network versus out-of-network. Been a lot of discussion about out-of-network versus in-network in our industry. We're well aware of that, but we still think that strategically it makes sense to stay out-of-network on some of your big contracts. But we also enjoy some very good relationships with our in-network payers as well. I would see, in the future, less and less out-of-network opportunities in the next 3 to 5 years, but we'll still continue to monitor that and sign contracts that make good business sense for each partnership going forward, whether that's in-network or if we remain out-of-network.
Thank you, Tony. Next question. What is First Surgical's highest margin surgery specialty, and could you possibly give some more color into how the margins break down for specific surgeries?
Wow, it's a good question. Well, if you break down margins by specialty, you have to also look at the time allotted in the surgery. For example, there are some very simple otolaryngology procedures, or ENT that we know it as, ears, nose, and throat, that can take as little as 15 to 20 minutes. So in terms of return on your investment, some of those procedures pay very well. Traditionally, the best returns are in our bariatric surgery, spine surgery, and reconstructive surgery. The bariatric surgeries, or those that are overweight, they have implants or hardware that we call it that cost money to do the case, anywhere from $5,000 to $7,000. So although we'll get paid on that, there's costs associated with doing those cases. Reconstructive plastic surgery, reconstructive surgery, the necessity for implants are less there, so I would say that the margins are good there, although some of these procedures can take up to 2 to 3 to 4 hours. Spine surgery has traditionally been a specialty that a lot of people like to participate in because of the higher margins. But then again, with spine surgery, you do have implantables and hardware issues that you have to account for from a cost perspective. Pain management cases that we do are pretty simple for the most part. Again, we are talking about surgery, so there is no such thing as simple surgery. But pain management, for the most part, the costs associated with doing those cases are less significant than, say, spine or bariatric. You can enjoy up to 35 to 40% margins on some of these bigger cases that we just discussed, bariatric, reconstructive, and neuro. The key to being successful from an economic perspective is to handle your costs and control your implant and hardware costs. We beat down our vendors and have good relationships with them, but we also have to buy things in bulk, in group, in order to keep our implant costs down. A lot of times when you're negotiating with payers, you have to negotiate the implant costs ahead of time in order to get favorable managed care contracts. So the better margins are in the specialties of bariatrics, spine orthopedics, reconstructive plastic, and you can enjoy up to 35 to 40% margins in those.
Thank you, Tony. You just discussed briefly buying implants in bulk. Could you give some color into who your medical device suppliers are? Are you able to achieve greater margins or economy of scales on purchases because of your numerous locations?
Well, Jim, we use a group purchasing company, a GPO, if you will, by the name of Amerinet, and we've been with Amerinet for about 10 years now, and through Amerinet we enjoy the ability to buy in bulk. It would be the equivalent of a Walmart for clinical supplies, and being affiliated with a group purchasing organization like a Amerinet or a Cardinal, it allows you to enjoy volume and discounted purchases of hardware and implants. It's an absolute must to be a part of a GPO in order to keep your costs down. But the most important, just as important as cost, is the accessibility of supplies. Many times in our business, you can have shortages in different supplies, and Amerinet, for the most part, takes care of us and allows us to have easier access for different supplies. there are too many vendors to mention, quite honestly, for us to mention. But for 10 years, we've had a wonderful relationship with a lot of our vendors that, on a weekly basis, if we're a grocery store, the analogy is you have trucks rolling up to our facilities every morning, bringing supplies and implants and things of that nature to get our procedures done in a timely manner.
Thank you, Tony. Next question. What is the status of your transition of ASCs to HOPDs, and would this be for all of your ASCs?
That's a good question. For those that might not know what that is, there's hospital outpatient department. There's a trend in our country for surgery centers to align themselves with hospitals. You have benefits in terms of efficiencies, aligning yourselves with a hospital. At our hospital here in Bel Air at First Street Hospital, we plan on having First Street Surgical Center being a part of our hospital at some time in the near future. HOPD is a trend that you'll see in our country with alignments of surgery centers, and again, it's just the mindset of aligning yourselves to be stronger. If you're a part of a hospital, bigger hospital system, you'll benefit from economies of scale, perhaps greater reimbursement, less overhead, and efficiencies. So First Surgical, in terms of the grand scheme of things, HOPD is something that's very attractive that we will look at on an individual level for our surgical centers. But first and foremost here at First Street Surgical Center and First Street Hospital.
Thank you, Tony. I believe you touched on this, but if you wouldn't mind going back a bit, could you go into some more detail on how contracts with insurance carriers contribute to greater case volume?
Yeah, it's a good question. I think one of the ebbs and flows of managed care contracts that individuals, companies, they have to have their employee base have access to health care. And as the system becomes more and more constrained, you have to balance out if your employees have access to different facilities. So in theory, the pros and cons of going in network is you're going to probably give up on margins. Your net revenue per case is for the most part going to go down, but what you're giving up is you're also going to access quite a few more patient lives that are covered by that plan. So that's the economic analysis that you have to do. If your net revenue per case goes down 10 or 15%, yet you're going to triple the database, if you will, of patients, you should see the volume go up. And in theory, if you sign a good contract, your volumes will make up for the net revenue per case decline. And that's a lot of the analysis that must happen to go in network.
All right, Tony, I believe that will conclude our Q&A session for the day. We thank you for taking the time to participate at the RedChip Small Cap Virtual Conference. On behalf of the audience and all of RedChip, we know you're busy and we appreciate it.
Thanks for having me, Jim. Enjoyed it. We'll talk to you next time.
This report is not a recommendation or solicitation to purchase or sell any security, nor does it constitute investment advice. Visit RedChip.com for full financial disclosures on RedChip clients.